Welcome traders to another video. Today we're going to be talking about one specific topic, that is accepting the risk. Accepting the risk of our trades, accepting the risk of the potential losses that we may incur. It's so crucial so that we can remove the emotions from the equation. I encourage you to invite humility into your trading processes, especially if you want to survive long term and have great success and consistent success over the long term, to generate wealth consistently. If you're a gambler, this may not apply to you. But if you want to be a consistent trader, I encourage you to invite humility into your trading processes. Now, how do you do that? How do you invite humility into your trading processes, and what benefits can it really help obtain for us? So accepting the risk, is all about knowing how much we are going to lose. How much can I lose? That's pretty much the only question that we need to ask ourselves. And this question is essentially ignored by so many traders, so many people in the markets, that it ends up catching up to us whenever we do take a losing trade. Now, the funny thing is, no trader can win 100% of the time. We may win a lot, and I do believe we can win quite often and have a string of winning trades due to luck and skill. However, there's no guarantee that we're going to be able to predict the market with 100% success rate every single time. There are just too many factors, right? The market, stock price, the way the stock price moves, right? The way this moves up and the way this moves down and the way this moves back up again, it's ebbs and flows. It's created because there are so many other traders in the market with their agenda. They are submitting orders to the exchange, and we have to remember that the market is simply an auction. The market is an auction of buyers and sellers bidding the price higher or asking for lower prices, right? Just like how you would see at any other, maybe a car auction, for example. $800. Any takers? $800. $801. $802. $803. Any takers? Any buyers? Right? They keep bidding the price up. People want the stock. And that's the way the market works. And there's so many opinions circling around in today's market, in today's world, including my own. Right? I post some opinions on this channel sometimes, and I just like to share my opinions for educational purposes. You don't have to listen to them, but there are so many different opinions that's going on about where the market's going to go, where the stock's going to go, and where it has to go. And that's where we start getting very, very into, we start swimming in dangerous waters when we start saying the market has to do this, or the market will do this, or the market is going to do this, without leaving breathing room for the other side of the equation, where we ask ourselves, how much can I lose if I'm wrong? And this is how we invite humility into our processes. If I'm wrong, right? If I'm wrong, how much am I going to lose if I'm wrong? And we can always be wrong. No matter how good the setup looks, no matter how great a trade or a stock might be, or there's news coming out, or the stock's doing a deal, or maybe our friends gave us a stock tip and maybe they've been correct before. And when we see, how good the setup looks, right? Maybe it's an A+ setup, or maybe it's a stock tip from a friend, or whatever. We start envisioning. I know I've done this before, and I encourage you to think about perhaps a time when maybe you've done this. You start thinking about all the potential rewards that the trade or the investment might offer you. Maybe you're just thinking about the great sum of money that you can acquire from this trade. Maybe you're thinking about a better retirement or showing off to friends and family, validation. Maybe you want a shiny new car. Maybe it's leaving your job, leaving that 9 to 5 job. You don't want to work here anymore. This stock, this investment, this play, this trade, it's going to provide me so much money. It's going to get me closer to that goal. And I don't blame you guys for that. And I've done that myself before too. And it's completely human nature to think about the reward. And the cool thing about it is that the reward might actually exist, but we must acknowledge the risk that comes with it. This is so incredibly important. Without risk, there is no reward. And we just jump to conclusions so fast. We jump to the reward. We start thinking about the reward that the setup can offer us so quick. We don't consider this portion. And accepting the risk at an internal level is so critical. Because if you don't do that and you're caught off guard and you risk too much, or you just don't consider the possibility of losing, and when the market shows you that you're wrong, things change very quickly. You start to feel fearful. You start to feel different. Your euphoria is completely just canceled out and thrown away. And now you're starting to ask many questions when the market turns around, right? So let's go over 2 examples just to kind of give ourselves a better feel for this, right? So let's consider 2 traders, okay? Accepting the risk. We have 2 traders. We have trader A and we have trader B. Both of them will have $100,000 accounts. And both of them are given a rule of risking only 4% per trade. 4% per trade just means that if they are to take a loss on any given setup, they should not lose more than 4%. This is going to be for a leap option. They will both be trading leaps. Leaps are long-term equity anticipation securities, aka just an option contract with like a year till expiration. That's it. And they are going to acquire these leap contracts, it will cost both traders money. And one leap contract costs $3,500 for one. Trader A buys one contract. Trader B buys 3. Now, automatically you can see that the total debit paid, aka the amount of money they put into the trade, this is $3,500. This one over here will be $10,500. So this is how much money trader A has at risk, and this is how much money trader B has at risk. Now, for context, trader B was very, very excited about the potential rewards that could come with knowing about this potential play. A friend actually gave him a tip. That friend has been right before, and that friend told him that this stock could perform very, very well. And it will very much likely perform very, very well due to a news catalyst coming out in a few weeks. That is the thesis. First of all, it's probably recommended that you don't take tips from friends without doing your own due diligence. Trader A also received a tip from the friend, but they did their due diligence and they did their analysis and their research as well. Trader B did not do that. They did not do their own analysis. Trader A did. Trader A acknowledges this rule right here, that they can only risk 4% of their account per trade. Both traders do believe that there's a high probability that the stock will go up. Trader A is within the risk parameters. They are only risking $3,500. They are less than 4% of their account value. They are risking less than that, right? 4% of $100,000 is $4,000. Both of these traders should not lose more than $4,000 on this trade. Trader B is risking $10,500 because they're thinking of how much reward they can potentially get from this trade. They're greedy. But they don't realize that in the moment. They don't realize it, right? They don't realize that they're euphoric and they're thinking ahead in the future and they're putting expectations on the market. That's the biggest difference right here. Expectations. So this is what happens with the stock. Okay? Both traders expect the stock to move up, but what really happens is this. Here's the graph. Here's their entry point. What they think is going to happen is they think the stock's going to continue rising, but what actually happens is news comes out. The economy is breaking. Tariffs are being released into the global economy. Deglobalization is happening and free trade is eroding. Equities and businesses begin to suffer because the cost of goods will become exponentially higher. Therefore, that drives the stock price lower, which was completely unexpected from both traders. The difference is that Trader A prepared for the worst case scenario. Trader B did not. So the stock actually ends up moving downwards and loses 10% of its value. Sound familiar? The stock loses 10% of its value, and both traders are down 50% on their positions. Keep in mind that they have leap options. Keep in mind that this happened within a few weeks, let's just say. This happened within 3 weeks. And their expiration date for the leaps is a year. Their leap options are down 50% within the first 3 weeks of opening up the trade. Now, the dollar value that this equates to will be $1,750 loss. That's how much they are currently losing, Trader A. And Trader B is losing much more. They're losing $5,250 now. And they could lose even more. Trader A could also lose more as well, despite them already being down 50%. They could lose another $1,750. However, the total debit that they paid, $3,500, is within the risk parameters. Trader A feels non-emotional. They are objective still. They are objective. They are calm, cool, collected, and they can still think rationally with their prefrontal cortex. The prefrontal cortex is responsible for your logical decision making. Trader B, on the other hand, is fearful. They are surprised and confused because they don't know what to do. They are confused. They are asking themselves questions. Should I sell? What is this stock going to do? They go to other people for help. They start asking their friend that gave them the tip, what is going to happen next? Will the stock turn around? Trader A ignores the noise. Trader A understands that they have so much more time on their leap still. And Trader A is completely objective. They look at the entire fundamentals and the sentiment of the overall economy, first and foremost, because that's the catalyst that's driving the stock price down. Then they also completely, with a rational and easy mind, they're able to observe the company fundamentals. They're able to look at the all the different metrics that are going to contribute to the health of their thesis, like earnings per share, maybe company projections about how they're going to handle the tariffs, or they're also looking at support and resistance levels, or looking at the technical analysis. And they are able to still remain very clear minded and say, hey, I still believe in this stock. And I can afford, this is the most important thing, right? They can afford to continue holding on to their leap if they wanted to. They can cut it, they can take a small loss. And even if they take this small loss of $1,750, they're good. They lost 1.75% of their account if they close their loss now. Trader B loses over 5% of their account if they close out their trade now. Both of them have the exact same trade on. The only difference is that Trader B took 3 contracts while Trader A took 1 contract because Trader B did not accept the risk. They got too greedy. They thought about the reward. They thought about how easy it is to potentially make money. So Trader A is left with so much more flexibility in their processes. They can hold on to the trade if they want to. They can cut their loss now. And if the worst case scenario happens, they lose $3,500. And that's the worst case scenario that happens. And that's probably not going to happen. If it does, they lose 3.5% of their account, which is within their risk management rules. And they stay in the game long term. They get a paper cut. They're not bleeding a lot. Yes, it's a loss. It sucks, but it's not a lot. And they can move on. They don't dwell on the loss. Trader B is in a tough situation. They're emotional. They feel pain in their chest. They feel that hole in their stomach. They're losing money. It's financially hurting them. It's emotionally burdening. Their emotions spill into other areas of their lives. They hop off their screen and that's all they can think about while they're at dinner with their friends and family, or while they're watching their kids or anything like that. They're financially hurting themselves because they got greedy and took on too much risk. And they have to pay the price for that. And the unfortunate thing about it is some people actually do fall into this trap, and even worse, they even buy even more contracts and they give themselves traumas. They give themselves emotional traumas, and then the next trade that they take, or that they are thinking about taking, once this is over, once this whole situation is done and over with, they're hesitant about market opportunity in the future. They're hesitant on their trades. They feel scared even before they put on a trade that even might look good. Trader A doesn't run into that. Trader A understands that losses are part of the system here, guys. Losses, the best traders are the best losers. They take the losses with humility. They envision the losses beforehand. They know that every single trade, they don't know the outcome. They don't know the outcome. Even myself, let's stop thinking that we know the outcome of a trade. That we know it. We don't know it. We do not know what the outcome of the trade is going to be. We can get a good idea, right? We can kind of draw up a plan. We can think of what might happen, and we can be very damn close to being correct, right? We can be very, very close to being correct, right? That's where our internal confidence, that's where analysis comes in, right? That's where we make our money as traders. We see opportunity. But at the end of the day, we don't know for sure. If we knew for sure, why don't you just throw your whole account into the trade if you know for damn sure, right? Why don't you? Doesn't that make sense? Let's just make a ton of money. But the truth is, we don't know the exact outcome. So we need to manage our risk appropriately. We need to follow the risk management procedures, and we need to invite humility into our processes, saying that, hey, no matter how good this trade looks, no matter how good this setup might be, I understand that I could lose this trade, and that's okay. Therefore, I will manage my risk accordingly, and I will accept and envision and imagine the loss in my head. I will imagine it before I even put on the trade. This is such a good exercise to practice. Imagine you taking the loss before you put on the trade. Trader A does this. He purchases the contract. Trader A purchases the contract for $3,500, and automatically they imagine themselves losing that $3,500, and they're okay with it. And if they weren't okay with it, if they don't feel satisfied, if they don't feel content after taking the loss, then they're going to reduce their risk. They're going to find a way to reduce their risk, lower the cost of the leap option. Maybe they'll turn it into a debit spread, or maybe they'll find a different strike price or a different expiration date, or maybe they'll buy stock, right? Who knows, right? They're going to make some sort of adjustments to lower the risk. They're going to find a way. And if they don't find a way, then they're not taking on the trade. It's that simple. Trader B just gets greedy, and they get euphoric when they see the great setup. So that's the example right there. Overall, in general, we need to accept the risk if we want to be successful in the long term, because accepting the risk balances our expectations we are not placing expectations onto the market, and then when the market shows us that we are wrong on the trade, our expectations are balanced. Therefore, there is no emotional pain. When we hold expectations onto the market, or just on anything in life, and those expectations are not met, that brings emotional pain. We feel angry, annoyed, distraught, frustrated, tired, fearful, sad, right? Anything in life, think about how you've had expectations for something and expectations just weren't met. It's disappointing. The market gives us no reason to be disappointed if we don't have any expectations about the outcome. That's what this revolves around. The outcome of the trade. Outcome of trade is unknown. Hold no expectations of the outcome. And no, this does not mean that you can't have conviction, that you can't develop a thesis in your mind of what you think the market's going to do. That's healthy. You need to do that. That's the only way you're going to deploy risk, right? But with the outcome of the trade, just bring that humility, saying before you deploy it, just know that, hey, at the end of the day, I truly don't know what's going to happen next. It's just probability. And you might win, like, let's be real, you might win a lot of trades out of, 100. It really just goes into the overall larger sample space, right? The sample space is important. Sample size, let's say you take 100 trades, and let's just say you win, let's be optimistic here. Let's say you win 85 wins. You have 85 wins out of 100 trades, right? I think that's possible, right? You can be really good. You can get really good at this craft. So you get 85 wins. That's going to be an 85% win rates, right? And you lose 15% of the time. Oh, well. 50% loss, right? 50% loss ratio. That's good, man. That's really good. And it's all dependent on the broader sample space of your edge of your analysis. When you're doing analysis, just think of the larger sample space. Think of it, your edge playing out over 100 trades. Don't think about the individual outcome of any particular trade, because we don't know the individual outcome of any particular trade. That's also what I'm trying to infer we don't know the outcome of any particular trade. And since we don't know the outcome of any particular trade, then we must accept the risk that we take at an internal level because we might be wrong. We must accept the risk at an internal level because we might be wrong. And as long as we do that, there's nothing for us to be disappointed about. We can take losses like that. They're going to be so easy to take losses. It's easy. I took a loss. Who cares? Of course, you got to go back in and journal it and kind of figure out what you did wrong, right? To get better. That's part of the winning mindset. But you're not dwelling on it. You're not emotionally frustrated. It's not hurting you, and it's not damaging you financially or emotionally, and you're not, you're not carrying that loss into other places of your lives emotionally, and you're a good trader. The best loser wins. The best loser wins, all right? So have balanced expectations. Actually, hold no expectations of the outcome of the trade. The outcome of each individual particular trade is unknown. Focus on the larger sample space. Okay, focus on taking over what your sample size, how your edge will play out over 100 trades. Focus on how your edge will play out over 100 trades, not just one individual trade. Have good, consistent risk. Manage your risk and accept it every time. Thank you for watching. I hope this video helped even at least a little bit. I really do appreciate it. And I will see you on the next one, traders. Thank you.